Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I'll answer some of your guys' questions. I see a bunch of questions here, and I'll give you my opinion on those questions. It says, Andy, Rick Rule recently said on Stansberry, the Fed will break something, panic in reverse course. Do you disagree with this? Could you explain? Personally, I agree with him given their history. Yeah, something in the system. So we've got a lot of companies that are in a lot of debt. And if they were to refinance that debt at higher levels, there's other things like currency exchange rates, where currencies could have problems as interest rates go up. And I can't tell you exactly all of the currencies and which ones matter and which ones don't and any of that. I'm not an expert in all this currency stuff, but I will just say that it's very possible that something happens in the system. And last time something happened in the system in 2018, it was around this level. So I think that we are getting to levels around this level where something could happen. And I don't know exactly what that first thing necessarily is. Obviously, you can see some problems in Europe with their bond markets, and something will probably happen. I don't know what exactly, but he's probably right, is my guess. And they'll probably reverse course potentially. So there's nothing really there to explain because I don't necessarily know all of the ramifications of increasing interest rates and what could break what. But something could happen. They'll panic and they'll reverse course. Yes, I think that's a high likelihood. Housing started to decline. So that's something I could touch on here quick. I'm going to go to Twitter. I posted this on my Twitter. My Twitter, just to show you, is @finding_finance if you'd like to add me there. And if I go on down, I did add housing starts slow down, but still above average. And housing permits are also slowing. So we did see a slowdown. We went to 1.549, which is still above the average, but they are slowing down. And then we also have a slowdown in the permits issued, 1.695 million. And it is slowing down. So that doesn't mean that we have to panic. What that means is that the housing market is slowing down, that interest rates, and especially the rate of increase of these interest rates, the rate of increase of mortgages has been phenomenal. We're at like 6.5 or 6.2 or whatever it is, mortgage rates at this time. That's ridiculously fast from 3% to 6.25%. I don't know if we've seen it go up that fast. But that is the current state of housing starts. Housing starts is a driver of inflation. And if we were to look at our long-term, I'm going to long-term trends here, and we look at the long-term M2 money supply. The M2 money supply usually leads inflation. Inflation is lagged by about 18 months. We had this gigantic spike in inflation. The money is in the system, and that money is working its way into the inflation numbers. Now, these two lines aren't completely the same. You can create money and have it not go into our inflation numbers. The consumer price index is how they measure it. How it gets into the consumer price index is usually through higher commodity prices. So the commodity prices are higher. We have increasing oil prices and natural gas prices, which will result in higher inflation numbers. I think the inflation will remain high because of the problems in energy. So I think they'll be out a ways, and they're increasing interest rates to slow the growth of money down. That's what they're trying to do. And that growth of money comes from housing starts, the loans against housing starts. And it is slowing down a little bit, but this here is going to take 18 months to hit the inflation numbers. It takes about 18 months to work its way through. So it's going to take some time. Then it's going to take some time for the housing starts to slow down as well. So everything is lagged after it. We're just looking at the leading indicators. Now, looking at June 11th, this is the latest weekly update of real estate. And I posted this also on Twitter. The median listing prices, these are the listing prices over year. This is all changes year over year. The reason we look at things year over year is because we want to view them with all the seasonality taken out of it. And right now we're up 17%. And this is the median listing price in the week ending June 11th. The new listings is up 3%. Active listings, which is your inventory, is increasing. It's down year to date, but it's been increasing recently. And you can see that inventory is increasing a little bit faster. Now, 17% on a very low number isn't a huge increase in inventory, but it is increasing. So the housing market is starting to show signs of slowing down in terms of inventory. That's where it starts first. Then your days on the market, time on the market, will start to go down as well, which that is going down. So the market is slowing down. It doesn't mean it is stopping. It is slowing down though. So the housing starts is slowing down, and we have to see where that goes. One data point isn't a trend, and the inventories are creeping up a little bit. That doesn't mean house prices go down. It means that house prices are going to probably slow down. So that's what we've got there in that perspective there that I wanted to share with everybody. Looking at this, it says, Andy, assuming your demographics thesis is correct, and also the mortgage rates rising substantially, do you think we could see the upper and lower ends of the residential real estate market decouple? Starter homes increase in value because millennials have to have them, but upper level homes go sideways or drop because the mortgage rates make them unaffordable for people already on the lower end of the housing ladder. And so they just stay put in their current houses at low interest rates. That very well could be the case. Again, guys, I'm not like this end all be all, know everything about real estate. What I do is I try to look at the data and then draw conclusions from the data. And we are going to we have to first slow down. We have to slow down this move in real estate first. And I have to see the inventories come to a level which are more balanced. We're not there yet. And then we're going to see home prices slow down in the rate of increase. And we're going to see all this play out here. And speculating on different levels of house prices, I don't really do that. I've never done that and really looked at the history on it. So I don't necessarily know exactly what's going to happen there. I do know that money's rotating and sloshing all around right now. And we've got lots of volatility. That volatility obviously is annoying to a lot of people because you're seeing your account values go all over the place, especially in these highly volatile and leveraged commodity stocks. It's pretty gut-wrenching if you're not used to this. And also, I mean, a lot of people, like, I look at a lot of history, and that's where I gained a lot of this, we'll call it knowledge. But I've only ridden on the back half of a commodity bull market of the last one. I haven't really lived through an entire full cycle of a commodity boom. So a lot of it's based off of research. A lot of it's based off of previous charts and logic. But it doesn't necessarily prepare everyone for the emotional ride that you're going to go through. And, you know, I've prepared for it as best as I could, and I'm just riding through it. And I created a strategy in the beginning of this, which is basically, if the market conditions are ripe, hold on through it. There's no reason to sell. Now, if we lose the housing market, which I don't think we'll necessarily lose it, I think it will soften. I think it will soften, and it highly depends on what interest rates do. It highly depends on what the Fed does with those interest rates. It all depends. But right now, they're probably scared that the money supply was increasing from housing, and they just took all the stops out and said, raise those the mortgage rates as high, you know, very quickly to a level that's much higher than where we are today. It's going to slow things down. And I'm not in the crash camp that things are just going to turn and go into a crash. They have to first slow down. This is like moving a large boat in the sea. Once you get some momentum going, it's really hard to turn it quickly. So that's what we're going to watch together on the channel. That's what we do on the website, a platinum membership if you want to join. That's what we do on the website, and look, and you guys can ask me questions and I can answer them and what I've seen in history and stuff. And we can look at the charts and try to make some conclusions from charts. And I don't use technical analysis as my only thing. I look at everything. I'm looking for alignment for everything. Alignment between the ratios, the market conditions, and the technical analysis. That's where you get your entry points. You get into the stocks and then you ride it for as long as the ratios are favorably changing for you, and also that the market conditions are right for them to remain favorable for that changing ratio. That changes favorable for your investments. So that's what I'm doing, is I'm just riding through it. And this stuff doesn't move quickly, so you kind of just have to sit and wait. You have to wait, maybe 6 months to a year to see a clear trend that is changing. And remember, there's a lot of things that are changing all rapidly right now. Interest rates are changing rapidly. The stock market's selling off rapidly. We're getting these deleveraging type events where everything gets sold off across the board. And it's very volatile. It is very volatile. And obviously no one likes going through all of this and going through that volatility. See him here. It says, Andy, why is there such a divergence happening between copper gold ratio and interest rates? That's a really good question. I don't have an answer for you on why they would be diverging like this. Copper is, so usually you have interest rates and the copper to gold ratio remain linked. Maybe they're trying to do stuff in the markets. I don't know. Maybe they're trying to, maybe people are scared. I don't have, you're never going to know that answer. People will give you an answer and they probably don't even know if that's true or not. But all we can say is there's a divergence. We don't necessarily know why. The why comes later. You see this first. And what he's talking about, the copper to gold ratio is highly correlated to interest rates usually. And if we're coming into a deflationary crash, you're going to see your copper to gold ratio drop. It's going to drop quite dramatically, and your interest rates will drop. And what that means is people are positioning, they're selling copper at a faster rate than gold, and then they're positioning in bonds for the crash. Usually banks do that because they know that a deflationary event can be coming from the destruction of credit. They're the ones that know that it's coming. They make the loans, they can see that people are defaulting on the loans and that you have a problem. I don't think we're in that type of event. We are increasing our interest rates. The interest rates are putting pressure on all these different areas. And the interest rates going up is that pressure. It's driven by inflation. They're trying to basically stop or slow down the inflation that's in the system by increasing interest rates. It's going to take some time, though. And things could break in the system. What that means is things could start going awry in currencies, in different bond markets. Remember, we're increasing our interest rates at a pretty quick pace versus history, and we're coming from very low interest rates. So if you were to look at it from a percent increase, they are quite dramatic in the system. So when people say something could break, we're going from a very low interest rate of like nothing. And just any sort of raise or increase in interest rate are going to basically break your weakest links in the system wherever they're at. And that pressure will be seen and felt, and they're going to have to make decisions if they're going to live with that pressure and breaking in the system. I don't necessarily know what's going to break, but something will at some point. I don't know what. And we're just going to look at it and react to it. But what's the reason they're increasing interest rates? It's inflation. We have problems in commodities. And I think a couple years out, we're going to have even bigger problems. That's my viewpoint. And I look at the liquidity coming into the system, which is all real estate driven. So that's the other thing I look at. Looking at this, Peter Lynch quote is pure gold. Those who want to pundit to predict for them where the bottom is or which sector is to take off or which stock to pick or are asking the wrong questions. Only you can make that kind of assessment based on the kind of investor you are. The commodity investor needs a strategy that is way different from a tech investor, crypto investor, or real estate investor. Predictions are completely useless. The only power you have is to do your own research on companies that you believe into your core. Diversify your investments, hold for 10, 15 years, stop looking at the day-to-day, and get on with your life. Time in the market always beats timing the market. Always for day traders, you have my sympathies. I don't know how you do it. It's definitely not for most of us. I don't day trade. I just find what's cheap, I invest in it, and then I hold on. And as long as the market conditions are right, I hold on to it. So yeah, I agree, Ron. You're right. Serious but maybe stupid question. When can we expect to see a bottom? Will there be indicators that we are approaching a bottom? How long might it take? Thanks. Well, I think we put the bottom in. I think what's happening is we're getting a retest move in a lot of different commodities, especially uranium. I think we've took a launch mode up, we've consolidated, and then we're starting to pull back, almost like we want to do a return move to the breakout. Maybe some can make it all the way back, maybe some won't, but I just don't feel like selling out, because when the thing reverses and goes higher, I don't want to be left out of it. And it highly depends on money flows and liquidity. The money is flowing and sloshing all over the place. And right now we're going through volatility, and I'm just riding through it. I'm riding through it. So I don't know when that bottom will happen. We need the overall markets to slow down the rate of descent. The faster they sell off, the more coupled the markets get, and the more deleveraging happens in the system. That's what's happening. Margin calls and stuff like that. What do you think of Art Berman? It's not Bergman, it's Berman. Especially his prediction for lower oil prices. He very well could be true. I mean, he was calling, like, he said way back, I was getting a lot of comments that oil would not go over $80 a barrel, that oil would not go over $70 a barrel. I don't agree with a lot of his predictions. I don't make predictions. What I do is I say, well, oil could potentially go here based off of historical ratios. That's not a prediction. I'm just saying historically, if we were to get to 200 and something dollars a barrel, that is equaling a ratio of gold to oil of about 10 to 1 or 6 to 1, somewhere in that range. So that would be over $200 a barrel if that were to repeat. Could it go there? Yes, it could go there, but I'm not predicting that it's going to go there. What I'm doing is I'm looking at inventories saying, well, inventories are low, demand is increasing, and that is the psychological threshold top that we've hit before. So I'm not, I'm very weary on those who are making predictions. What I'm looking at is what is the possibilities and what is the risk reward for something like that to happen. I still think that oil looks good. I still think that the inventories are low, and I don't think we've solved any sort of problem. Now, someone says double tops everywhere, demand destruction. We have not had demand destruction in oil. We've had strategic petroleum releases, and we're still drawing down on inventories. The demand has not been destroyed. That is a false statement. Double tops doesn't mean you have demand destruction. And it doesn't mean much of anything. You have to look at inventory levels. Inventory levels are your glimpse in the resultant of supply and demand. That's what results. Are we drawing or adding to inventory? Now, some areas are adding to inventory and some are taking away from inventory, depending on what you're looking at. And these things don't happen instantaneously. You have to wait some months to see if there's a trend in place. Trends don't happen with one data point. So keep that in mind. So I'm coming on down here. Says, Andy is a calm voice you want to hear in the midst of pundits who keep screaming and crying about the gloom and doom. Markets go down, but they don't go down forever. They always come back, always. Andy and every prudent investor like him know that, and that's why they do well. Your calmness and long-term outlook is an inspiration, Andy. Well, so I don't think that the market conditions are as bad as what most people think. And I agreed. I agree with this. I have some pretty good entry points with a lot of my entries, but I just don't, I don't go from a good-looking environment to panic mode in 1 second. When people see the markets going down, they use price to panic. That's exactly what you don't want to do. If you're an experienced investor, you just want to say, all right, is the fundamentals, are they still intact? Are inventories still being drawn down? If that's all a fact, a true fact, then stick with the trade, stick with the investment, stick with it. I don't think things have been solved. I don't think anything's been solved. And I'm not a person to just run into cash or some other thing because I get scared. Investing's about being logical, not being emotional. Just because, I'm just gonna recap some. All right, I'm gonna recap it real quick. When I was looking at this, I did sell out at the bottom of 20. It was coming back down. I didn't get the perfect timing here. We saw interest rates drop. in January and February of 2020. We saw interest rates like start to tank. It was really starting to tank. So I sold out of my positions of technology stocks. I sold out of them. I wanted to move them to commodities. It looked like that was a time. So I sold out, the market crashed, and I so luckily bought it when it into strength as it bottomed. I stuck my neck out there a little bit. I bought almost entirely in the gold and precious metals area. I bought physical, and I bought a lot of the mining companies. We got that reflation up in August of 2020. I rode that, and I rode it back down a little bit into September, October of 2020. I swapped my money into a lot of oil and uranium. And I said, those I think will be good because we're going to get an energy crisis from the oversold condition in oil. We went negative. All these oil companies pulled way back on all their investments. And I was like, there's going to be a problem here. And then Biden was saying that he didn't want to invest in oil and fossil fuels. So I was like, well, we're not going to get new investments. And then we had the ESG movement where these large hedge funds and investment funds didn't want to invest in oil and natural gas. And I said, there's going to be a problem in oil and natural gas. There's going to be a problem in uranium eventually. So I thought there's going to be an energy crisis. So I put a whole bunch. I overweighted oil and uranium. Those are my two overweight positions. And I kept some of my diversified mining companies and royalty companies. That's where I basically put a lot of my money in. And I sold some of the junior miners that I went in at the bottom there, which did well. I got lucky. I got lucky on some junior miners. So then I rode those up. And right now, I don't see the trend changing. Oil looks good still. The chart looks good. Natural gas still looks like it has a problem. And there's still a large disparity between Europe's pricing in Asia versus America. That's all intact still. The fundamentals are all still there. There's no reason for me to panic. The market, I think, is selling off because we have an energy crisis. And they're trying to slow everything down by increasing the interest rates. The interest rates are putting pressure and money's starting to flow. And when looking at this and what I did and the thesis is that the housing starts is what I thought, expansionary phase, increase in money supply, and I saw that commodities were going to be favored. So I went into commodities. I think this commodity bull market will last 5 to 10 years. Something on the lines of that. We're at year 2 of me holding this stuff. And I'm just riding through it. I knew at some point that this rotation of money was going to happen due to increasing interest rates. I called it all out in the thesis. The thesis is a set or strategy based off of things that have happened off of history. So the strategy or the thesis is you go to an expansionary phase, you get inflation. Inflation increases the interest rates. Interest rates puts pressure on bonds and stocks to sell off. Money rotates out of those. And during that rotation period, I said, I don't know what this is going to look like. We could be coupled. We could be decoupled. We could go back and forth. And I didn't know how fast this would sell off. I didn't know how slow it would sell off. No one knows that. But I knew that the money was going to rotate at some point to some degree. I don't know how long this will last. I don't know that necessarily. But the money will rotate. You'll start to see money choose precious metals and commodities over everything else. And we're seeing that in the ratios. The CRB index in relationship to the S&P 500 is favorably changing for the commodity index. So everything's playing out. It's playing out exactly like we thought. And now we just have to wait through it. We're going through a volatile period. And when it gets volatile, everyone starts panicking. So that's it says here, it says funny, I hear Andy panicking. I'm only 2 minutes into the clip and he already said 4 times he's not panicking. He's not selling. I think we're in a liquidity crisis. That's his opinion. The reason I'm saying that is I'm panicking for you guys. I'm not panicking for myself. And the reason I keep reiterating that is, guys, I'm not panicking because most everyone else is. That's a lot of people. They start to panic. And I'm just right through it. And it's different. Remember, I'm out here talking to everyone, and there's people that are depending on me, at least that's kind of how I feel, to get some information. And their level of panicness could be tied to what I'm doing. Right now, I'm not panicking because I think that the overall markets are still ripe and the problems are occurring from where we are investing. I don't think where we're investing is necessarily the problem. I should say. They're not going to get smoked to the downside. I think they're actually the ones that are causing the problems in the system. They're causing the interest rates to go up, an energy crisis. So that's kind of how I view all this stuff, and I just stick in those investments on the long side until they get fixed. It's that simple. Everything's playing out basically to the prescribed thing, but I'll tell you, I'll be honest, I don't know what this looks like in the short term here. We've got money sloshing around. We've got interest rates going up at pretty incredible speeds. And the rate of change, and things are selling off pretty fast too in the overall markets. And that's causing panic amongst some people. But I'm just holding on, guys. That's my strategy, and we'll ride through it. If you guys like the analysis, give me a thumbs up, subscribe to the channel, subscribe to the website, Platinum membership below. It's in the description link if you want to check out more of what I have to think. I've got a lot of financial education stuff on there. Platinum membership. We've got a question and answer session coming Saturday morning, 7 a.m. Mountain Standard Time. If you want to join that, become a Platinum member, and you can join it. You can ask me questions there directly. I'll answer them. I don't skip over things. At least I don't think I do. And I'll give you my honest opinion. And I'm pretty honest and straightforward in the clips. I record those clips if you can't make it, and I post them on the website for viewing later on. All right, guys, we'll catch you next time. This is Finding Value.